You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. Let's talk about REITs today. I have a lot of questions as of late, mostly because with interest rate going down, some REITs are finally going up, finally getting some love in the market. And then investors are asking, well, should I have REITs in my portfolio? So does it make sense, right? So let's take a deep dive on the REITs today and see if they would be a good fit for your portfolio. So first things first, the real estate investment trusts are one of the 11 sectors there are. And they are mostly a different sector because of their tax structure. So the tax structure is different. That means that metrics are different, and also that it's probably better off to hold them in a tax sheltered account. So I'm not telling you an advice here, but the thing is, REITs are not paying a dividend, but rather a distribution. And within that distribution, you can find a mix of dividend, but also a mix of return of capital. What does that mean? So return of capital, you'll also see ROC for the abbreviation. It's like money that you have invested in the REIT and now you're getting it back. So it's not taxed. So woohoo, good news, right? You're getting the money, you're not getting taxed on it, but it does affect your adjusted cost base. So the price that you pay. So for example, you pay a REIT $10 per unit, and then you get $1 of distribution. That dollar is completely return on capital. So then your cost is not $10 anymore. It goes down to $9. So as long as you keep those units, that's great because you got money like without getting taxed. But whenever you sell, then you're going to be taxed on a larger capital gain. So again, just verify all of this with your accountant or tax expert. But most of the time, it is probably better to have those REITs in a TFSA or in an RRSP or any other tax sheltered account, just because you don't want to go ahead with all those calculations, keeping track of your new adjusted cost base and paying capital gain down the road. The other thing that makes them different is because of their tax structure, the earnings per share is completely useless. So when I look at a REIT, I try to use the dividend triangle, but the dividend triangle is a mix of three metrics, including revenue, earnings per share, and dividend. So I can use the dividend distribution like this. The point is like you're getting money back. So that's great. The revenue works as well, but the earnings per share, completely useless in this case. What is important is the fund from operation per share. So FFO, and in an ideal world, you go with the adjusted FFO, so AFFO. That is kind of like the similar metric that you can use to see if the dividend is safe. So if the company generates enough funds from operation to cover the dividend, the distribution, then you should make then the dividend should be safe, and you could have some room for increasing. Now, on top of having a different tax structure, this sector is quite interesting because the business model is a bit different. Because overall, the big picture of the business model is you buy properties, you leverage them to buy more properties, and then you rent those properties. So that's pretty much the big picture. But then when you narrow it down, there are different types of properties. So you could have commercial REITs, which you have like retailers in it. You can have apartment REITs where you rent to people, so they rent their apartment. It could be offices, industrial properties such as like distribution centers, warehouses, and other type of industrial properties. It could be casino as well. Vici properties only specialized into casinos. It could be hotels and motels and also healthcare properties. So as you can see, those are all different niche in the real estate world. Each of them has a different type of growth expectations, different types of risk. The best example we can see right now are office REITs, which are greatly struggling because there's a lot of employees that decided to work remotely, like either full-time or partially, but in both cases a lot of like tenants are thinking, well, I'm not going to rent 3 floors anymore, we're going to go down to 2 floors or 1 floor, because most of my workers are just going to share an office or share a desk, so I need less space, which could be good for the tenant because they're going to save a lot of money, but pretty bad on office REITs. So while office REITs are struggling, it could be completely different story for apartment REITs or for industrial properties, right? So when you invest in a REIT, you obviously go for a place of stability, definitely not looking for super strong growth players. The business model is really easy to understand. We like the fact that we see like the properties, regardless if it's an apartment building or a warehouse, it's easy to picture. The downside, though, it doesn't grow that fast, and it's also very hard to move quickly. So again, for the offices, and now some office REITs are trying to convert some of those floors into condos or other purposes, but that takes time, that takes a lot of money, and it's not super easy to do. So do you need REITs in your portfolio? Well, not more or not less than any other sectors. In fact, the key here is a lot more about understanding the sector, understanding what it brings to your portfolio, and determining if it's like something that you want or not. So REITs are great for understanding the business model. It's concrete, it's real, easy to figure it out. It's known to, like, many of the REITs pay a generous yield, monthly distribution. So that's also great for constant cash flow, but it's not a growth machine. It doesn't move fast. It doesn't grow fast. So if you're expecting like high single digit, double digit return year after year, you're going to be disappointed by this. It's more a sign of stability, with a great protection against inflation, for example, but it's definitely not a sector for everybody as well. But it's pretty much the same thing for all the other sectors, right? So for me, I have like one REIT in my portfolio, mostly because I focus on dividend growers, and there are a lot of REITs out there, but not that many that will show a strong dividend triangle if you replace the earnings per share by the FFO per share. So I rather look at other more growth-focused sectors, but that's just me. It could be something else different for you, and that will be fine as well. So instead of trying to figure out if you need one sector or not in your portfolio, just focus on the one that you love the most. Actually, like 3-4 that will be close to 20% of your portfolio. And then for the rest, it could be different, like between 5 to 10 to 15%. I like to have like a well-diversified portfolio across like 7, 8 sectors, sometimes 9 sectors. That's good. But if I don't find a great stock in a specific sector, I'm not going to settle down for something that is not aligned with my strategy or does not completely fit my investing journey, and that should be true for REITs or any other sector. If you are looking for more information about retirement, I will be hosting a webinar next week, a free webinar on retirement withdrawals. So we're going to talk about how to build your portfolio and protect your capital, how to create a safe and reliable income from your portfolio, and of course, how to set the withdrawal sequence. So we're not going to get into the tax optimization, of course, because tax optimization, it really depends on your situation. If you have a pension fund, if you're married, if you have like a business or rental properties, all of those things could have an impact on your withdrawal sequence. However, we can determine how you can set your portfolio to make sure that your portfolio is retirement ready and will generate enough income, or you will have like a mix of dividend and a cash reserve by selling shares as well to generate the income you need. So if you want to know more about this, you can go at moosemarkets.com/webinar. So it's moosemarkets.com/webinar, and you can register there. The webinar is Thursday, September the 19th, so next week at 1 p.m. If you register, you will have the link for the free replay. If you don't register, you're not going to get that link. So it's really important that you register before September the 19th. moosemarkets.com/webinar. We're going to see you there. And in the meantime, tomorrow we're going to talk again. So don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.